Welcome to vTalkInsight, Risk Sentiment Daily for February 27, 2026. U.S. equities have slipped, volatility is still contained, and markets are weighing fresh geopolitical risks against an AI-driven rotation in leadership. Rising U.S.-Iran tensions, cracks in private credit, and a shift away from crowded tech trades are reshaping risk appetite. So let us unpack what that means across assets today. Risk sentiment today looks cautious, with a clear downside focus. The S&P 500 fell a little more than 0.5% in the latest session, yet the VIX volatility index is still below 20, signaling nerves but not panic. This mix points to a market that is trimming risk and reassessing crowded positions rather than rushing for the exits. The caution is driven by two big stress points. First, U.S.-Iran tensions and the associated risk of a disruption to Gulf oil flows have moved back to the top of the macro worry list, with Brent crude edging up towards $70 and gold supported as a hedge. Second, investors are paying closer attention to private credit and software-related defaults, where leverage is high and liquidity in some vehicles is being tested. Offsetting those headwinds, several constructive forces remain in play. The AI infrastructure boom is still delivering exceptional earnings for key hardware and server names. Equity leadership is rotating towards cyclicals and international markets, and expectations for Federal Reserve rate cuts later this year continue to support quality fixed income. Compared with a more upbeat, hedge-heavy tone earlier this week, the balance has shifted toward greater respect for tail risks, but not yet to an outright risk-off stance. U.S.-Iran tensions and energy supply risk are the dominant bearish driver today. Troop buildups, fresh sanctions, and a third round of indirect nuclear talks in Geneva under a looming deadline have pushed the Middle East back into the foreground for macro investors. Analysts warn that a U.S. military strike on Iran would almost certainly trigger direct, forceful retaliation against American and Israeli targets, taking the situation well beyond symbolic responses. The real systemic risk lies in a disruption to Gulf energy flows, especially a temporary closure of the Strait of Hormuz. Iran has threatened Gulf oil infrastructure and shipping, and Bloomberg Economics highlights that even a short-lived closure of the strait could severely constrain global oil supply. China currently absorbs around 90% of Iran's crude exports, so any interruption would have particular significance for Asian energy markets, as well as global inflation expectations. Market commentary frames a major supply-side shock as the single biggest downside risk for both equities and bonds, with the potential to trigger sharp corrections across risk assets. Oil prices have already moved higher, with Brent around $70 and risk premia are building as traders await outcomes from both the Geneva talks and upcoming OPEC Plus decisions. There is some comfort in the view that U.S. military action is unlikely before April due to diplomatic efforts and calendar constraints, but if talks fail, the risk of an energy shock into the U.S. driving season becomes a key scenario to watch. Private credit stress and potential software defaults form the second major bearish theme. Industry data indicate that roughly 23% of private credit portfolios are tied to software companies, often with leverage around 10 times EBITDA, leaving lenders exposed if growth stalls. Marathon's Bruce Richards has warned that software sector defaults in some private credit pools could reach as high as 15%, far above historic norms. Beyond default risk, liquidity and transparency are emerging as critical pressure points. Private credit funds with significant retail participation have already faced redemption pressures, highlighting the mismatch between illiquid loans and investors' expectations of quick access to cash. Listed business development companies are trading at extreme discounts to net asset value, reflecting market concerns about valuations, opacity, and potential losses that are not yet fully visible in reported numbers. There are some offsets to this bleak picture. Large asset sales in the space are still occurring near par, suggesting that, so far, stress is more about liquidity than a broad deterioration in credit quality, and some high-quality managers report minimal exposure to the most troubled software names. Even so, The combination of elevated default forecasts, tight spreads, and growing retail participation means private credit remains a key fragility that can amplify shocks, especially if broader risk sentiment deteriorates. Tech and software equity fatigue is another important headwind. Several high-profile companies have delivered solid or even exceptional earnings only to see muted or negative share price reactions. NVIDIA posted a roughly 73 to 80% year-over-year surge in revenue with very strong guidance, yet the stock suffered one of its worst days and chip names broadly sold off, dragging major indices lower. The software complex is facing similar skepticism. Salesforce shares fell on a tepid sales outlook despite a $50 billion buyback plan, and analysts have been cutting price targets across the sector on concerns about terminal growth rates and AI-driven disruption. Other names such as Intuit, Autodesk, and Duolingo have seen cautious outlooks or outright misses met with sharp share price declines, reinforcing the idea that the bar for software earnings is now much higher. At the same time, AI-related software is no longer getting an automatic valuation boost just for having exposure to the theme. Commentary stresses that the era of effortless re-rating is over, with investors now demanding clear evidence of monetization and durability before rewarding AI stories. That is contributing to a broader pattern where U.S. tech and discretionary stocks, even with superior earnings, are underperforming international markets that have weaker fundamentals but stronger technical momentum. Against this more defensive backdrop, the AI infrastructure boom and earnings strength remain a powerful bullish driver. NVIDIA's data center revenue has surged around 75% year-on-year, with guidance pointing to roughly 85% growth next quarter and gross margins near 75%. The company holds an estimated 95% share in key AI segments, and demand for its chips reportedly exceeds supply by roughly 12 to 1, underscoring the intensity of the current investment cycle. Importantly, AI demand is broadening beyond a handful of mega-cap hyperscalers. NVIDIA now reports its data center revenue is roughly evenly split between hyperscalers and a wider base of enterprises, neocloud providers, and sovereign buyers, suggesting a more diversified and durable customer mix. Dell's outlook reinforces this picture, with a record $43 billion order backlog and a bullish revenue forecast for fiscal 2027, alongside a 20% dividend increase and a $10 billion share buyback expansion. Credit markets are also a clear beneficiary of the AI capex wave. AI-related corporate debt issuance has already exceeded $32 billion this year, including around $20 billion from Alphabet alone, channeling the investment boom into bondholders as well as equity owners. There are medium-term questions around rising leverage, surging memory costs, and the absence of China-related revenue in NVIDIA's current guidance. But for now, the scale and breadth of AI infrastructure spending continue to support a constructive view on select technology, hardware, and credit exposures. A second key bullish force is the rotation into cyclicals and international equities. Flows and performance data show leadership shifting away from long-duration growth and U.S. mega-cap tech toward materials, industrials, and energy, signaling a pro-cyclical rather than defensive move. Even as the recent S&P 500 rally stalled near technical resistance, there are few signs of distribution in cyclicals or base metals, suggesting that this rotation still has room to run. Internationally, earnings growth is now accelerating in regions such as Japan, Europe, and emerging markets excluding China, while U.S. tech and discretionary sectors are seeing slowing profit trends. Strategists at major banks are tilting equity overweights toward emerging markets and Europe, and EM stocks have outperformed the S&P 500 for 3 straight months and European indices for 5. Latin America, Japan, and Europe are favored for the combination of better earnings, attractive valuations, and greater policy flexibility. On a multi-year view, structural themes also favor this shift. Deglobalization and years of underinvestment in infrastructure and commodities are expected to support value-oriented, inflation-sensitive markets, many of which sit outside the U.S. Client flows already reflect this, with net equity inflows to the U.S. falling sharply from prior peaks as investors diversify toward mid-caps, quality cyclicals, and international exposures, even as they remain alert to stock selection risk in regions facing trade tensions and competition from Chinese manufacturers. The third bullish driver is a supportive rate outlook combined with selective bond opportunities. Despite strong fiscal stimulus and an AI-driven investment boom, the Federal Reserve is expected to stay on hold in the near term, and markets now price in only 2 cuts with no immediate balance sheet reduction. Even so, many analysts still see Fed rate cuts as likely later this year as the labor market stabilizes and inflation remains moderate, a backdrop that is broadly constructive for risk assets absent a major supply shock. Recent price action suggests bonds are regaining some of their traditional hedging properties. Bond and equity markets have reverted to more classic risk-off correlations, with treasuries once again acting as a buffer during equity drawdowns, even if the stability of that relationship is still in question. Global fixed income correlations are also falling, as divergent inflation and growth regimes create opportunities to position selectively across regions and maturities. Within fixed income, there are pockets of perceived value. Intermediate duration U.S. bonds yield above 4% and are seen as offering return potential similar to last year if disinflation and slower growth play out, while UK gilts currently trade at a yield premium of about 110 basis points over French bonds. U.S. fixed income is already outperforming equities this month, reflecting both valuation adjustments in stocks and a rotation toward higher quality assets as investors seek compensation for taking risk in a world of lingering geopolitical and credit uncertainties. To sum up, risk sentiment has shifted to a more cautious, two-way stance, with U.S., Iran energy risks and stress in private credit balancing powerful tailwinds from AI infrastructure spending, cyclical and international equity leadership, and a still supportive rate backdrop for quality bonds. Markets appear comfortable taking selective risk, but the focus is clearly on whether an oil shock, a misstep in private credit, or a deeper tech unwind could upset the current equilibrium. Watch the Middle East headlines, default trends in software-heavy private credit portfolios, and the durability of the rotation into cyclicals and non-U.S. markets for clues on how this balance evolves. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.